The European Central Bank voted unanimously today to hold interest rates at 0.5%, confirming no move for an extended period of time. But what of investor capital in the region, and what does forward guidance mean? On the phone now with this information is Luca Jellinek, Head of European Rate Strategy at Credit Agricole. Luca, despite a vote of no change today, for investors looking to today's events for guidance, what information did we gain?
I think the most interesting thing from the ECB's standpoint is that they're still very committed, like a lot of other central banks, to maintaining short-term rates, up to 2-3 years, nice and low, taking out some of the interest rate hikes that are implied by the yield curve, and especially keeping the volatility lower, so kind of spreading a sense of calm and well-being. At the same time, they have to take into account, they have to recognize that the economy seems to be improving, and obviously they don't want to appear to be out of touch on that front. If I had to summarize what the ECB kind of said today, reading between the lines, is, hey, if the PMI goes up a little bit more, we're not going to hike like we did in 2011. And that I think is a very important message for the market.
The IMF has warned the ECB that it may need to cut rates. The euro area region is in its longest recession ever. What would you do were you in Mr. Draghi's position?
Well, I think as Draghi pointed out, the problem the ECB and in fact all central banks in the G7 have right now is that their policy is already super loose. The market rate, the 1-week rate in Europe is about 0.1%. Which is why people recently spoke about cutting the deposit rate. It's still a possibility. If the improvement we've seen recently were to falter for whatever reason, I'm convinced that the ECB would cut rates. But there's only so much they can do from that point of view. I think that, as they keep saying, the really fruitful action would be on the macroeconomic side. But also, of course, they're working on trying to keep EMU closer together, more integrated, reestablishing the single banking market. I think on that front, perhaps, things need to move further or will move further, but I guess it's a matter of waiting until after the German elections.
Let us return then to this idea of forward guidance. New Bank of England Governor Mark Carney is said to be a fan, and it's a phrase which punctuated today's ECB press conference. But what is forward guidance, and how does this impact expectations moving forwards?
It's a very interesting question, and a lot of academics and monetary economists have looked at this. The orthodoxy is that forward guidance isn't worth very much if the market perceives that you're still wedded to a given reaction function, Taylor rule, if you will. So if I tell you that as soon as inflation expectations go up, I'm hiking, and in the meantime I promise that I won't hike for 3 years, you can't take that too seriously because if inflation expectations go up, you will hike. So is it worth anything? I think it is, because it communicates in every case, not just in the ECB case, that yes, we still have our mandate. Yes, of course, we want to meet those qualifications, but because we've had an unusual recession and we still have massive balance sheet issues globally, certainly within the EU, we're going to be extra cautious. We really want to see real evidence of growth of the recovery having taken hold before we even consider raising rates. And I think that is not, it's not a zero content policy. We mentioned it before, and I think it bears repeating. To me, what Draghi and the ECB are saying is, this time we will not do a 2011. We're not going to hike just because we got a few months of strong PMI. We need to be sure that recovery has taken hold, and it's taken hold throughout the euro area. So in that sense, I think the forward guidance is useful, and of course it's also flexible. It's vague enough that it allows you to, modify policy as you go along. The fact that we've seen the curve become very convex in Europe again is not an accident, and it's been in a lot of other countries. So I think that's a real value of forward guidance. It's a limited one, but it's a real one.
And lastly then, to market response. Mr. Draghi commented that capital continues to flow into the euro area. Is this reflected in euro US dollar and euro area bond performance?
I think it is to some extent. I think my interpretation would be that his comments were more in terms of international investors becoming more sure that EMU will not break up. This was in the context of OMT and government policies and rebalancing. So I think one thing that they're obviously very interested in is reinforcing this view that the sovereign crisis is, if not over, at least not going to get worse, and that therefore there is this new faith in the EMU project. I think he's right. Obviously, their point of view is particularly encouraging on that front. I still think it's early days, but certainly, it's no longer the orthodoxy that EMU is going to blow up, and unfortunately, analytically, for a lot of people, it was last year before OMT.
Many thanks, Luca. Interested in Indonesia? Then click back to Dukascopy TV to watch my colleague Monica Gibson tackle the Indonesian economy in an exclusive interview today. Goodbye for now.